About a year ago, Wall Street analysts handed investors what they called a blueprint for a slam dunk investment, a stock that was supposed to absolutely dominate its sector. They even called it their top pick for 2025. Well, today on Iron Financial, we're not just going to look at that blueprint, we're going to stress test it. We're putting it under pressure, we're going to examine every single load-bearing wall, and we're going to find out if that foundation was solid or if it was just built on sand. Our job here is to help you forge a stronger portfolio, and believe me, that starts with separating the Wall Street hype from the hard numbers. All right, let's get into it. Here's our plan of attack. First up, we are going to reconstruct the original bull case for Floor Decor. The exact story Wall Street was selling investors. Then our market skeptic is going to jump in and start probing for the initial cracks in that argument. After that, we flash forward to the moment of truth, the official report card, the actual earnings release. We'll put the forecast and the reality side by side to really measure the miss. We'll diagnose exactly what shattered the blueprint. And finally, the verdict. Based on today's numbers, is this battered stock a solid opportunity, or is it a dangerous trap waiting to spring? Okay, let's set the scene. You gotta picture this. It's February 2025, the home improvement sector, well, it had been in a really tough spot. Interest rates were stubbornly high, you had existing home sales cratering to 30-year lows, but analysts were starting to see some green shoots. They were forecasting what they called an inflection point, a major rebound. You could feel this palpable sense of optimism that the worst was over and a recovery was, right around the corner. And at the very heart of that optimism was one company they believed was coiled like a spring, just ready to completely dominate that recovery. And this is the statement that really set the tone. William Blair, a very respected analyst firm, they didn't just have a buy rating on Floor Decor. They didn't just call it an outperform. No, they planted their flag firmly and declared it their top pick for the entire year.
And you got to understand, that's a heavy statement. When a firm puts that kind of conviction behind a call, they are putting their reputation on the line. They're telling the entire market, hey, this isn't just a good company, it's the company you need to own. And that builds a really powerful narrative, one that can suck in a ton of capital. But, as we always say, narratives are one thing. The hard numbers are something else entirely.
Exactly. And this wasn't just a hunch. It was a detailed architectural plan for massive growth. So let's break down the forecast they laid out for everyone. First, comparable sales growth of plus 3%. Now, this number is absolutely critical. It signals that the existing stores are healthy, that they're drawing in more business, not just that the company is opening new locations. Second, net sales growth of almost 10%. That implies aggressive and, more importantly, successful expansion. Opening new stores and immediately grabbing market share in a recovering industry. Third, adjusted earnings per share of $2.10, which represented what they called outsized earnings growth of over 20%. This means they expected all that new revenue to flow efficiently straight to the bottom line, showing some serious operational leverage. And the payoff for investors who believe this? A price target of around $150, nearly a 50% jump from where the stock was trading. This was the blueprint for a perfect investment. And these right here, these were the steel beams that were supposed to hold that entire structure up. These were the core assumptions. William Blair believed FND would be the dominant share gainer, just as the entire home improvement industry turned upwards. And they built their entire model on a huge macroeconomic assumption, a 3.7% year-over-year increase in existing home sales. They also believed the company had made permanent structural improvements to its gross margins and had streamlined its operating costs, creating the leverage for that outsized earnings growth we were just talking about. And the final kicker was an expected boost from recovery efforts after some natural disasters. Every single pillar was pointing in the same direction, up, up, up.
Okay, so that's a strong-looking structure. I'll give them that. On paper, it looks perfect. The narrative is clean, the numbers are compelling. But here at Iron Financial, our job is to play the adversary, right? We have to kick the tires and check that foundation for cracks. Because when a story sounds that good, you have to ask what everyone else might be overlooking. You have to question the blueprint itself before you put your hard-earned capital on the line. Because let's be honest, the most dangerous investments are often the ones where everyone agrees. And that's the question I really want to pose here. Because even the most detailed, most convincing architectural plans can have a fatal flaw. And that flaw, it might not even be in the company itself, but in the environment it's built for. So was this bullish forecast built for the world as it actually was? Or was it built for a world that the analysts hoped would exist? That is a critical distinction, my friends, because hope is not a sound investment strategy. We got to look for the fine print in this blueprint. And here it is. Here's the first potential hairline crack, the valuation. You see, hidden deep within that William Blair report was this number, 47.3. Floor Decor was trading at over 47 times their own very bullish forward earnings estimate. Now, to put that into perspective, that's a premium valuation not just to its peers, but also to its own historical average, which was actually closer to 40. So what's the crucial point here? The market was already pricing in a huge amount of success. The stock wasn't some bargain waiting to be discovered. It was priced for near perfection. And that means there was absolutely zero room for error. If any one of those pillars we just looked at started to wobble, the whole structure was at risk of a complete collapse. And this gets to the heart of the single biggest point of failure. When you really dig into the report, you realize all those impressive company-specific forecasts for sales and for comps and earnings, they were fundamentally dependent on one single external factor that the company had zero control over: a significant recovery in the U.S. housing market. The analysts assumed a 3.7% increase in existing home sales. But what if that didn't happen? What if interest rates stayed stubbornly high and the housing market just remained stuck in the doldrums? Well, then the entire bull case, that beautiful blueprint, would be worthless. It was a high-wire act with no safety net. Okay, so that was the setup. A very bullish, very detailed forecast from Wall Street, and some very valid, foundational questions from the skeptics. So now, let's fast forward 1 year. The speculation is over, the calendar flips to February 2026, and Floor Decor releases its actual audited full-year 2025 results. This is it. This is the moment of truth. This is where we stop talking about blueprints and we start inspecting the finished building. And at first glance, the headline number doesn't look like a total disaster. Full-year net sales growth came in at 5.1%. Now, remember, the forecast was 9.7%, so yeah, this is a significant miss. But positive 5% growth in a challenging environment, some people might look at that and say, hey, that's not so bad. It shows the company is still expanding its footprint, still growing its top line. But the top line number often hides the real story. And here is the real story. This is the number that matters most for any retailer: comparable store sales, a decline of 1.8%. For anyone new to this, comps are the single most important metric for a retailer's health. They strip out all the growth that just comes from opening new locations, and they tell you about the core health of the business. Are your existing stores getting more productive, or are they getting less? The bull case called for a positive 3%. The reality was a nearly 5-point miss in the wrong direction. This isn't a small crack in the wall. This is a foundational pillar completely buckling under pressure. And that weakness, it flowed directly to the bottom line, just like it always does. The final diluted earnings per share for 2025 was $1.92. Now, on its own, it's a slight increase from the prior year's $190, but when you measure it against the blueprint, it's a clear failure. The analyst target was an ambitious $2.10. Missing that target by 18 cents confirms that the outsized earnings growth they promised never, ever materialized. So now it's time for the direct comparison. No more narrative, no more interpretation. Let's put the blueprint from William Blair side by side with the finished building from Floor Decor's official earnings release. This is the heavy lifting, folks. This is where the hype gets completely dismantled by the hard numbers. Okay, just let this sink in for a second. On every single key metric, the forecast wasn't just wrong, it was wrong by a wide margin. Net sales growth was just over half of what was projected. EPS missed by about 9%.
But that comp sales miss, that is the most damning piece of evidence on this entire slide. It's a nearly 500 basis point swing from a healthy positive to a clear negative. This is the metric that tells you if customer demand at your core stores is growing or if it's shrinking, and it was shrinking. It tells us the core assumption that an inflection in consumer demand was here was fundamentally completely flawed. The rebound just never came.
So this leads us to the most important question in our entire analysis. Why? Why was the forecast so spectacularly wrong? Was this a failure of the company's execution, or was it a failure of the analysts' macroeconomic assumptions? What were the forces at play that the bullish analysts either totally missed or just dramatically underestimated? Let's get into the diagnosis. Let's do the postmortem. Right, and I just want to double-click on this concept one more time because it is the most important lesson for any investor here. Total revenue can be misleading, especially for a company that's in heavy expansion mode. Comps, on the other hand, tell you the truth. FN's negative 1.8% was a massive, flashing red flag that demand was softening at the very core of the business, and that is a problem that simply opening more new stores cannot fix. And here are the reasons, pulled directly from Floor Decor's own earnings call. This is the company, in their own words, explaining what broke the blueprint. First, and most importantly, softness in existing home sales. The very foundation of the bull case crumbled. That 3.7% growth that the analysts banked on, it never happened. Second,
A direct result of that, a 4.2% decline in customer transactions in the fourth quarter. Fewer people were walking in the door and buying anything. Third, the customers who did come in were shifting to smaller, less expensive projects. Those big-ticket renovations were being put on hold. And finally, on top of all that, you had internal pressures like higher distribution costs and the early impact of tariffs eating away at margins. It was a perfect storm of macroeconomic headwinds that directly contradicted the analyst's sunny forecast. All right, so this brings us to today. The hype from 2025 has completely evaporated. The stock price has been absolutely hammered. The entire narrative has shifted. And that presents the ultimate question for an investor who's looking at this company right now. We've done the heavy lifting, we've deconstructed the past, now we have to look at the present. With all this damage done, is this a solid buying opportunity based on a new, lower valuation? Or is this a dangerous value trap? A stock that just looks cheap but has a fundamentally broken growth engine?
Let's start with what the company itself is telling us to expect for the year ahead. This is their official guidance for fiscal 2026. Take a look at the comparable sales line. They're guiding for anywhere between a 2% decline and a 1% gain. The midpoint of that range is negative. Think about that. Even management is telling us to brace for another year of weakness in their existing stores. Diluted EPS is forecast between $1.98 and $2.18. Now, at the high end, that's some growth, but at the low end, it's pretty much flat. The only clear positive here is that they're still expanding, planning to open 20 new stores. But as we've just learned, that can mask some serious core weakness.
And just look at the complete reversal in Wall Street's tone. The same community that was shouting from the rooftops that this was a top pick with a $150 price target a year ago has completely changed its tune. The consensus rating now is a lukewarm hold. The average target price has been nearly cut in half to around $82. And look at the breakdown. For every one analyst still saying buy, there are nearly 2 others saying hold or even sell. The slam dunk has become a jump ball, at best. This just reflects the new, more challenging reality the company is facing. The hype is gone, and it's been replaced by caution and a whole lot of uncertainty.
And this number right here, this is the result of that collapsed blueprint. After those 2025 earnings were announced, the stock price cratered to $66.17. That is a world away from the $150 dream that was sold to investors. It's not even close to its 12-month high of over $103. The market has delivered its verdict on the performance miss and on the weak guidance. The punishment has been severe. The question for us now is whether that punishment was an overreaction, creating an opportunity.
And this slide really summarizes the entire dilemma for a potential investor today. Yes, the stock is significantly cheaper than it was a year ago. That sky-high valuation of 47 times earnings is long gone. But the reason it's cheaper is because the fundamental growth story has stalled. The core engine of the business, those comparable store sales, is sputtering. So are you buying a great company at a fair price, or are you buying a struggling company at a price that only looks cheap on the surface? That right there is the definition of a potential value trap, and it's one of the easiest ways for investors to lose a lot of capital.
So what's the ultimate takeaway here? The story of Floor Decor over the last year is a powerful, almost perfect case study in the mission of this channel. It's a lesson in the critical importance of looking past the analyst hype, past the glossy blueprints, and doing the heavy lifting on the hard numbers yourself. It shows exactly why you must always identify the single biggest assumption in any bull case. In this instance, it was the housing market recovery, and then you have to stress test it. You have to ask yourself, what happens if this one thing doesn't go right? Because building a solid portfolio isn't about finding perfect stories. It's about understanding the risks and knowing the difference between a solid foundation and a weak facade. And that is how you forge strength in the market.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.